Welcome back. Take a look at futures this morning. We've got a rally underway this morning. Dow Industrials up 88. The Nasdaq up at 93 after a huge sell-off yesterday. The Dow tumbling better than 500 points on the session. Its worst day since late March. After yesterday's January CPI report was hotter than expected. The Federal Reserve now reinforcing its cautious approach to rate cuts this year. It sent interest rates soaring yesterday as well. Joining us right now is Bolvin Wealth Management Group President Gina Bolvin. Gina, great to see you. Thanks so much for being here. Your reaction to the CPI and the reaction yesterday on Wall Street, how do you see things?
Well, Maria, you know, the CPI is just one data point, right? Most of the increase in inflation we saw, two-thirds of the increase was in housing, and we still expected housing to come down. The reason is that building permits that are at an all-time high, and when this supply comes to the market, it's going to put downward pressure on the housing market. So we're also looking forward to the end of the month on February 29th. The Fed's preferred measure of inflation is the PCE, and that has a smaller component of shelter, and that's really going to be an important number. But the market is readjusting its expectations to interest rate cuts. Last time I came on, we talked about this, that the market was pricing in 6, maybe even 7 rate cuts, and the dot plot in the Fed is telegraphing 3. So there might be some choppiness until we get there, but it does look like we're not going to get a March cut. The probability of a May cut is about 40%, and it looks like the greatest percentage is going to be in June.
Cheryl.
Well, the market reaction, Gina, was pretty brutal yesterday. I mean, we had lows that we haven't seen since March of 2023. And in particular, it's not just the Dow, but let's focus on the NASDAQ. The NASDAQ lost 1.8% yesterday. And the stocks that got hit, of course, were the movers of last year. That was the Magnificent Seven, Gina. So this has become a stock story in addition to a Fed story. And you've got more and more predictions now that that rate cut isn't going to come until the second half of the year, at best case June. So I agree with you on that. But talk about the pressure we saw on the NASDAQ yesterday. How do we play this now?
So we still like mega cap tech. We think that is a absolute core holding. And look at NVIDIA yesterday. It was flat. So I don't think it was as bad. The NASDAQ was pretty much in line of what the S&P 500 did. And it's been an incredible year. I think this is a healthy correction. And in no way does this change my outlook for the year, that I think it's going to be a good year for stocks.
Tiana.
The Fed's messaging on all of this has remained remarkably consistent, even though they've said we're only going to have the 3 rate cuts next year starting in the second half of 2024. It was investors and Treasuries futures that ran ahead of it, right, assuming they'd have twice that. But the data has come in line with what we've expected, right? A lot of residual seasonality, that core services, excluding shelter prices, skyrocketing. Can the data come in worse? Do we think that CPI will come in lower? Because I know you're saying the PCE will be better because it has less of a shelter component, but those shelter costs are what people really feel in their wallets in large part. How does the Fed respond to the data? And do you think the data might actually get worse before it gets better?
I'm really focused on the earnings season. I'm focused on what's going to drive stocks. I think there can be some volatility, and I would recommend to my clients and to your viewers to be a buyer on these dips. We think it's going to be a really good year in the market. Take a look at earnings. We saw some earnings come out last night. We're in the middle of earnings season, and all of the economic data has been better than expected. When we look at GDP, when we look at Q4 earnings growth, if we take out those bank charges, earnings growth has been 7%. For this year, we think we could see earnings growth for double digits. And we think it's going to be a good year in the stock market. And I do think inflation is coming down. Yesterday's CPI report was just one data point. But the reason inflation is is coming up is because the consumer is still strong and they're spending money, and that's what causes inflation. When a lot of people are spending money, a lot of money is chasing too few goods. That's what's causing inflation. And I'd rather be in an environment where the Fed is not cutting rates because the economy is heading towards a recession, but is holding rates steady because the economic data is so strong.
Gina, are you surprised we have not seen a bigger impact from the 11 rate hikes? I mean, let's talk about all these layoffs, for example, right now. Instacart announcing layoffs. Roughly 7% of jobs will be cut as part of a restructuring plan. Paramount Global had a rough day yesterday, announcing it's going to cut 800 jobs. Just one day after reporting record Super Bowl ratings. There's more than 30 major companies cutting jobs so far this year, Gina. We're seeing cracks in this Goldilocks story, and yet we see optimism that there's going to be growth. You're talking about growth in the economy, but we really haven't seen the impact of those 11 rate hikes fully, have we?
I don't think we have. I think they're still working their way into the economy. But in terms of layoffs, Maria, it's terrible when people are losing jobs. However, it seems to be that companies are having layoffs to protect profits and not necessarily because demand is decreasing.
Okay, well, that's a good angle that we'll follow for sure. Gina, it's good to see you this morning. Thank you.